We have had, in addition to the inventories issue, you've got the China issue, you've got the Iran sanctions issue as well. And I just quickly want to bring up a chart on the Bloomberg here that looks at hedge fund positioning in WTI and Brent, both long and short. And we've seen it's the blue line here, and crude oil prices are in white. You've seen positions go down. It seems like some folks are saying with all of these X factors, we're just going to pull back on exposure.
I think that's fair. I mean, I think look at the action today. This is a pretty big move off of what are not meaningless headlines, but not super impactful. And I think we're becoming a little bit kind of exhausted, headline exhausted. And if you've been long and you've made money, it looks like, hey, is this still have the return profile that makes sense? And I think the other thing that people are looking at on the inventory numbers that you mentioned, the implied demand, the gasoline implied demand number was a little bit weaker. And that demand side is starting to have a bigger and bigger impact on the commodity. It's been that the supply side, the sanctions, what's happening in supply has been the driver of what makes the commodity work. But right now people are starting to shift back to the demand side and really take a look at it. But that being said, this is in no way an easy trade here to grind lower. We are literally one headline away, whether it be a supply disruption in a region or, a tweet from Trump saying that we're going to impose sanctions, to zero imports, that you see another blast higher. And I think, again, when you see hedge fund positioning come off, it might not be worth it to be in the game right here.
I love that you already gave some examples of what those headlines could be. Which of those is most likely to happen in this current environment?
My crystal ball up and quit on me last week with all the headlines. But, I think, obviously, I think the Trump tweets are more likely because I'm just using historical examples here. They've come out and he's pretty consistent and he uses them when he needs to spark some kind of recognition in the market. But I really don't know what it'll be, but I know it'll be something. Yeah. And it's going to come from somewhere. And I think that's why you're seeing hedge funds want to pull back a little bit. And it's emboldened some of the shorts who have stepped away and say, hey, I'm willing to put on a little exposure here. I feel like the conviction on the long side may be waning a bit. Yeah. Can I take a line in the sand at 70? Right. It might not be a high conviction trade, but I'm willing to put a little risk on there.
And there may not be a lot of conviction either way on the price of oil, but you seem to have a bit higher conviction when it comes to the companies, right? When it comes to energy stocks. And I know you like in particular midstream companies. What is it that's particularly attractive about them right now?
Well, there's a couple of things. So midstream has lagged the rest of energy on this huge momentum trade that started at the beginning of the year. It's kind of an under-owned, underappreciated. It's not a sexy trade at all. It's pipelines. And it has a kind of a small investor base. But if you look at their earnings in second quarter, where E&P companies had kind of messy quarters mixed across the board, midstream delivered, and they're also simplifying their structures and being extremely disciplined with capital and making good investments. So you've seen those MLP and midstream stocks rally let's call it 13% since the start of this third quarter. So I think they continue to be pretty attractive. And I like the fact that you're seeing investment from private equity. You're seeing Williams Brothers mentioned on their conference call, we see cheaper cost of capital coming from private markets than public markets. The public markets want this discipline and have a very short horizon, right? Like we're seeing with these volatile moves, whereas private equity is getting involved in being there. And I think as a longer term investor, that's attractive. That's where you want to see, you're seeing that money being put to work. So I think that's kind of what compels me to feel like they're still very solid. That's not to say, given the run they've had, we can't consolidate here for a little bit, but I still think they're pretty attractive.
The prospects are there. I'm glad you bring up the distinction between what private investors focus on, what public investors focus on, because when it comes to those E&P players, you say the numbers were kind of messy. Do you think investors are being too short-sighted when they focus on this relationship between CapEx and production? You made the point of saying that the companies are rewarded for keeping CapEx with production steady, even though maybe down the road, long term, that might not be the best thing for the company.
Yeah, I do think there's a little bit of a short-sighted aspect to that, but at the same time, you can't necessarily blame investors because they're graded on their monthly performance and they see inflows and outflows and they need companies to respond in kind. And also, let's be clear, there were times prior to this cycle when E&P companies overspent on those longer-term projects and it really punished investors. So I think they're trying to keep a tighter leash on it right now and really say, hey, no, we don't want to go down that road again. But you're right. I mean, I think to some degree, this investment in the opportunities they see should be rewarded, but investors just aren't there yet.
And to that point, I mean, there are quite a lot of projects that are going on right now, which you say is one of the other things that's not getting that much attention. I mean, it seems like there's a decent amount of breadth of projects and also number of projects.
Yeah, I think there are. And I think, even just something that came out last week that not a lot of people talk about, Japan is thinking about doing, a $100 billion infrastructure fund in the U.S. That's a huge number. That's, not for sure, not set in stone, but it's definitely a factor. And you're seeing a lot of money go to work within the energy assets across the globe, not just in the U.S., to be clear. And I think it is absolutely a positive. It needs to continue, these companies have to continue to deliver, though, for it to really get investors on the public side to continue to be excited.